Welcome back to Morning Trade Live. We've got stock futures mixed after rallying yesterday. It was a tech pop post-inflation. Joining us this morning to talk about what we've learned this past week, Dory Wiley is the CEO at Commerce Street Capital. Dory, welcome back to the Schwab Network. Good to see you.
Good to see you too.
Appreciate that. Inflation data yesterday seemed like the market was worried it might be a little hotter than just the expectations. How do you think this fits into our investing process right now?
Yeah, for those looking for rate cuts, it's bad news for them. The market's been ahead of the Fed all along, predicting, as many as 7 rate cuts in December. And so the market's in for another disappointment. It's kind of fighting the Fed here and has been for over 20 months. That number, what did it go up? 0.4%. Mm-hmm. So, that's the highest jump it's had in a year. And if you look at what Powell looks at, which is services inflation, ex housing, that jump was the highest since, in 3 years. So I think, I don't think there's any, how can you have rate cuts when you have this inflation looming and a strong GDP? I think the market's just going to have to deal with it. Now, having said that, we don't have to have rate cuts to have a good market. It's almost like winning the market off a bottle. It doesn't need that. The market's doing fine. The economy's doing fine. It's adjusted. If rates stay where they are, they'll be fine. The market will adjust. Banks adjust. Cap rates adjust, and it'll be fine. More volatility to the upside would be bad, but we don't have to have rate cuts to do well.
It's a really key point that it seems we've learned over the last 6 months, 7 months that rate cuts might be a bonus, but when earnings are reverting higher and you've got real growth in areas like this tech revolution that's happening, earnings ultimately are what drive the bus. So how then does that change the expectations in terms of what moves the market here? Because we have gotten very concentrated, though. It seems like the growth is really only in one spot.
It is, and I call it Mag 6, not Mag 7, because Tesla, which is more the cult stock and less fundamental for me. So people like to say it's a euphoria, and there's some euphoria in that, I'm sure, but there's a lot of fundamental reasons for this Mag 6 to take off, and they're doing fantastic. They make money, they coin money, and earnings estimates expand, and revenue estimates are continually expanding. You can't say that about the rest of the S&P. So if you think back, 15 years ago, when Amazon, and 20 years ago, when Amazon for 10 years didn't make money and ran a 5 to 6% margin, it was very difficult for me to get on that bandwagon because fundamentally it was just hard to get there. It was so ahead of itself. Now, that's been the blind spot of the market for the last 30 years, right? Because it turned out to be a great investment. But it seems much more clear when you have something like a NVIDIA that coins money, has a 50% margin, and things are happening way faster than they did 20 years ago with accelerated computing and AI. It doesn't mean that there's not euphoria in there. In fact, I'd like to see it drop about 20% to shake some of that stuff out. But there's a lot of fundamental reasons for Mag 6 anyway, and investors, particularly institutional investors, under-allocate Mag 6 at their own risk.
It presents us with an interesting situation. It's not really a bad one if they do well, because we could be parked in the index and just reap the benefits of a couple big companies sucking up capital. But it changes the game a little bit. It's a little bit of a swingier game that is going to be contingent on fewer businesses. So how do you talk with clients about diversification? How do you think about that right now? If the stock market's a couple companies, then we kind of become more active managers than maybe we intended to when we bought the index.
Well, you've hit the nail on the head for a lot of portfolio managers that take advantage of passive management through indices. You have to be a little more active. It is a stock picker's market, and you have to make sure that you're not under allocated to the Mag 6. You've got to have that allocation, and then you got to tilt. You got to decide, right? So we're under allocating Tesla. We're over allocate Microsoft and NVIDIA. but we're not going crazy with it. We just don't want to make sure that we're right there with the market and underperform. Because what happens is a client will come up and go, well, the S&P 500 is doing great. And if you're in all these different world indices and this, that, and the other, you're getting cream. So you have to make sure you have that allocation.
Okay. What about the bond side? If we think about the 60-40, killed us in 2022, doing great for us since, basically. But when you talk about the big disconnect between the market and the Fed still, does that make you worried about being deeply weighted in bonds?
It depends on where you are. I do think spreads are a little tight, a little bullish on high yield and other corporates. So we're sticking with high quality, high positive convexity bonds. Regarding the index, we might be just a little bit past on duration because the market has such a bias towards rate cuts. We think it's overestimating that. And I think that positions us well. But we're not trying to make a big duration bet. It's probably more of a quality bet. And then we make up the Sharpe ratios. The Sharpe ratios are so small in bonds. We do use some active managers on high yield, but on the short term, so that they're good at picking alpha. But we try to get that alpha in other areas like private equity and alternative assets.
Okay, when you look at the alternatives here, what appeals to you? Where do you feel that you can get some yield without overextending risk?
Absolutely. So one area is we've been very active in opportunistic industrial real estate. That market, there's not as much development going on, but we have some really good managers who have been doing it for a long time on the opportunistic side. So we get a nice yield. It's very conservative, full up on rents, good quality firms. We still like some select markets in multifamily. We're avoiding office real estate all over. Maybe a little retail, not a lot. And we're not heavy in real estate, probably a little underallocated. We love the GP investing in private equity, good current yield. We think that looks really good. We're not over allocating to buyout right now, but we're being very conservative of what we do. Good existing managers that have been doing it a long time. We have a bias at our firm towards SBICs, smaller, top decile, top quartile performing private equity mezzanine areas as well.
Okay. Like it. Always fun to expand beyond the stock talk. Appreciate the portfolio discussion. Dory, have a great weekend. Thanks for coming back to us.
You bet. Good to be here. Thank you.
All right, good stuff. Nice setup here for our session today. Dory Wiley, CEO at Commerce Street Capital.